welcome back to the post-lunch session. We have with us a CAS Ramasubramanian sir from Bengaluru. He will take us through the practical workings on the partnership funds taxation. May I now request Ramasubramanian sir to come and occupy the dais. May I now request the senior member CAG Purushottam sir to come and present a shawl and memento to the speaker. May I now request our regional council member CAS Rajesh from Coimbatore to formally introduce our session speaker CAS Ramasubramanian sir. Over to you, Rajesh sir.
Thank you.
Chairman of SIRC, CA Chinnamastan, Secretary, CA Naresh Gulli, colleagues in the council, Speaker of this session, CAS Ramasubramanian, sir, my dear members, good afternoon to one and all present here. It's a great honor to introduce 70 years young chartered accountant who qualified in 1975. He was in Bell for a short term of 3 years and he got into practice. His experience is more than my age. He is presently senior partner in MSSV & Co. Chartered Accountants, Bengaluru. He has presented various papers on direct and indirect laws in national and zonal seminars and study circle meetings. He is a member of the committee constituted by ICAI to prepare guidance note on transfer pricing. He is ex-member of Indirect Taxes Committee of FKCCI. He is also a director for programs on VAT conducted by the Bengaluru branch of SIRC of ICAI and Karnataka State Chartered Accountants Association. He is also a visiting faculty of IIM Bangalore, Indian Institute of Management, Bangalore. He is also a bridge player. With these few words, it's a great honor for me to introduce such a wonderful speaker for this August gathering. So welcome you for this session at SIRC. It's a great honor to have you here, sir. Over to you, sir. Thank you.
Thank you, Rajesh sir. Thank you for the nice introduction. May I now request Ramasubramanian sir to handle the technical session. The floor is all yours, sir. Good afternoon to everybody. I thank the SIRC and especially Dr. Falguna Kumar for making me read section 45B4 and section 9B. And it was really a treat to listen to Mr. Pradeep Kapasi after a brilliant introduction by Dr. Kumar to section 45.4 and 9B. Like some short form of cricket specialist, I don't know, I have always been assigned the post-lunch sessions. Either it makes you feel very sleepy or it keeps you awake. So let's see which is the true one. Normally what I used to do, I used to bring some slides and show on the various interpretations of statutes, which will in a lighter vein. But unfortunately, I didn't bring it today. So I couldn't keep you, that used to keep the people awake at least for about 10 minutes. So now in the morning session, we heard the learned speakers giving us the theoretical aspects of section 45.4 and section 9b. So we have a basic understanding of these two sections. Just to paraphrase, section 9b applies when a dissolution or a reconstitution takes place in a specified entity. For the purpose of discussion, we will just refer to them as firm and partner, as they are the 90 to 95% of the assessees covered under that section. So when a reconstitution of a firm or a dissolution of a firm takes place, and if an asset is given to the one of the outgoing partners, then the difference between the fair market value of that asset, which can either be a capital asset or a stock in trade, and its cost of acquisition, is treated as capital gains or profits and gains of business or profession, depending on what is given is a capital asset or a stock in trade. A lot of issues were raised: what is a stock in trade, what's a capital asset? Keep that in mind. That's one thing. Then 45.4 says that it applies only to reconstitution. It does not apply to dissolution. In the case of 45.4, if any sum of money and or a capital asset is allotted to a retiring partner, then based on a formula, the capital gains is taxed in the hands of the firm. So both under section 9b and under section 45.4, the income or the capital gains is taxed only in the hands of the firm, not in the hands of the retiring partner. What is the formula given in 45.4 is A is equal to B plus C minus D. A is equal to the amount of capital gains, B is equal to the sum of money, C is equal to the fair market of the capital asset, D is equal to capital asset, which is there in the to the balance of the retiring partner at the time of reconstitution. So these are the simple points to understand. And basically these sections have been brought in to get over the decisions of the Supreme Court in Mohan Bhai Pamabai's case 165 ATR 166 and Tribhuvan Das case. Mohan Bhai Pamabai case, a Supreme Court judgment is a very small one paragraph judgment. They simply approved the Gujarat High Court judgment. For the youngsters, I would like to seriously recommend, please go through the decision of the Gujarat High Court in Mohan Bhai Pamabai's case 91 ITR, where the concept of retirement, the partnership interest, and what is the right of a partner in a firm are so beautifully and excellently discussed and explained that will give you a basic idea about the partnership law and the taxation of that. Of course, that has been, a lot of amendments have taken place subsequent to that, but this gives you that, so please go through that. Now, what I have done today, as far as my subject is concerned, whatever we have learned theoretically in the morning session, I have tried to put some numbers to various situations. I have started with a very simple case and then developed them into further complicated issues. Wherever there are two views possible, I have stated both the views, and I will tell you which view I would prefer. So with this background, let's look at the we'll, as I said, no, during the last 1.5 years, so much discussion has taken place on 45B, 45.4 and section 9B. So what we are going to discuss today is the practical explanations of this. One thing I would like to mention is that the examples I given do not cover all possible types of permutations and combinations. In fact, some of the issues which were raised during the morning sessions are not there in this. I am not there because some of them I was not aware. I'm very grateful to the speakers that they have brought it on, so I can, possibly in the next session, I can incorporate them and discuss that also. So, subject to that, we'll take the simplest of the one where only section 45(4) applies. As we said, the only situation where section 45(4) will apply is where there is no asset allocation to a retiring partner. Because if there is an asset allocation, if it is a capital asset or stock in trade, section 9B would apply. So therefore, only a case to which 45(4) applies is a case where a sum of money is given to the retiring partner. So what are the facts? Let's say a partnership firm consisting of 3 partners PQR, each of them have 10 lakhs capital, profit sharing ratio is 50%, 25%, 25%. Most of the examples will have this basic figures as the same because I didn't want to change it. Now what happens is P retires. On the date of retirement, these 3 assets are revalued. Asset 1 is 10 lakhs is revalued to 25 lakhs. Asset 2 is valued at 75 lakhs. And asset 3, which is a self-generated goodwill, is about 60 lakh. That is why there is no book value. So it is only valued at the time of this. So you have a total profit on revaluation is 1,20,000. So the retiring partner's share is 50%. So the partners agree, saying that he will be entitled to 50% of the revaluation profit, which is 60 lakh. So a total sum of rupees 70 lakhs is paid to the retiring partner. So in this case, the capital gains is very simple. If you apply the formula, A is equal to B plus C minus D, B is equal to 70 lakhs, C is 0 because no asset is allocated, D is the capital account balance at the time of retirement is 10 lakhs, and therefore the 60 lakhs is to be charged under the head capital gains. And one more rider I would like to say is, most of these examples are on the presumption that the section 45(4), section 9B, rule 80A and rule 80AB are valid. Because in the morning there were certain issues raised on this, but I have got on the presumption they are valid, and if they are valid, how the capital gains has been worked out under various situations. So we have 60 lakhs as a capital gains. Whether this 60 lakhs is a short-term capital gain, or whether it is a long-term capital gain, or if it's a combination of both, how to work it out, we will see it in a later example. One point I would like to mention is very clear on this. Section 45(4) does not say that capital gains relates to what? What is the asset which is subject to the capital gains taxation? Is it the interest of the outgoing partner? Is it the assets which are allotted to the partner? If it is asset allotted to partner, what about money? The sum of money is not a capital asset, but still it is taxed under the capital gain. So therefore, one important point to understand is that the difficulty arises in classifying these 60 lakhs as short-term or long-term is because of the fact that the section is silent as to even what is the nature of basic asset which is liable to be taxed as capital gains. So we don't know what it is. The second point is, as they say, the section does not say whether such long capital gains will be long-term or short-term. One point which was not discussed in the morning, I will just take this opportunity to, how long I have, sir? Okay, fine. Because I'm
tea break, 3:45 tea break.
No problem. Tea break can be at any time.
We can shift it also.
So the point is that whether it is short term or long term has not been discussed. We'll come to rule 80A a bit later, But if you look at section 45(4) alone, nowhere it says that such a gain shall be taxed as a long-term or short-term. The problem for us to even determine whether it's a short-term or long-term capital asset is a problem because section 242A, which defines a short-term capital holding, short-term capital asset, with reference to the period of holding, is difficult to be applied because we don't know what asset we are talking about. That's what I explained earlier. What is the asset I'm talking about to say that it is that asset's period of holding is either short-term or long-term? Because the definition of long-term capital asset is very simple. Anything which is not a short-term capital asset is a long-term capital asset under section 229. So therefore, the point is that the section 45(4) is silent as to that. How, whether it is long-term or short-term. One view is this. Forget whether it is long-term or short-term. Section 112 is a carve-out section for taxing the capital gains. That in respect of long-term capital gains, it should be taxed at 20%. So if something is not a long-term capital asset, then everything else is a short-term capital asset and therefore it will be taxed because the Finance Act is very clear on this. Subject to section 112, any normal short-term capital gains will be added to your normal total income and taxed according to the slab rates. Subject, of course, to section 111A, 112, etc. Only if it's a long term. So you say that if the period of holding cannot be determined, because I don't know what the asset is, then definitely it is not a long-term capital asset, and therefore by a process of elimination, it has been treated as a short-term capital asset, is one view. The other view is this. For the purpose of your aggregation under chapter 6, that is section 70, 71, etc., 72, you have to determine whether in the case of capital gains, whether the asset is a short-term or short-term capital gains or long-term capital gains. That is fundamental to the computation of capital gains. And therefore, unless you determine first whether it is a short-term capital gains or long-term capital with reference to definitions given in section 242 capital A and section 229B, you cannot proceed further, and therefore this entire scheme fails. These are just one point I wanted to keep in mind because this was not discussed in the morning. So that's one thing I would like to do. So subject to that, we will now see this in case study 8. We will see how this 60 lakh is to be taxed, whether it's a short-term or a long-term capital asset. And also how this 60, as was explained in the morning, section 48 clause 3 says that the amount of profit chargeable under section 45(4) of the Act would be allowed as a deduction from the full value of consideration received of the remaining asset on transfer of remaining asset as may be prescribed. So we saw that rule 80AB has been prescribed by virtue of powers given under that. So hence the attribution of 60 lakhs also we'll see later to the remaining asset. And one more thing, if you have any doubt or in any example, you can raise those doubts immediately after that, so that it's much better to clear off at that point rather than waiting until the end or for the question and answer session. But you can ask a question and answer session also, it's up to you. Now we will take another example. This is also a case where only section 45(4) applies. The profit sharing ratio is same, 50%, 25%, 25%. Capital is 10 lakhs. Share of revaluation profit is also same. Revised capital is 70 lakhs. What the firm does is, Mr. P retires during the year, and then these are the assets which are revalued on the date of revaluation. The assets are revalued, asset 1, asset 2, asset 3 is revalued, the same profit on revaluation is 60 lakhs. Here what has happened is, as we saw, the only difference between example 1 and example 2 is that the revaluation profit of 60 lakhs belonging to P was credited to his capital account before retirement. So what was 10 lakhs book capital became 70 lakhs book capital on the date of retirement. But then, as was explained in the morning, the proviso to section 45(4) says that in construing the capital amount standing to the credit of the partner on the date of retirement, any revaluation profit is to be ignored. So you had a original capital of 10 lakhs, you had a revaluation profit of 60 lakhs, which became 70 lakhs. But because of the proviso that 60 lakhs revaluation profit is ignored, and the capital becomes 10 in the formula, and therefore the same amount as in the example 1. What is in the example 1? The entry was not passed at the time of reconstitution, maybe entry was passed later. Again, short term, long term, we will see the attribution. Then we'll see the next one. Same partners, capital ratio is, profit sharing ratio is same, capital is same, the assets are revalued, same, 10 lakhs, 45 lakhs, 60 lakhs. Now here is the case which we discussed in the morning about under section 45(4), the year of taxation is the year of receipt. Subject to what Mr. Kapasi said, whether the receipt is a constructive receipt, legal receipt, etc. But here, for the purpose of our discussion, let us take it a very simple case. Receipt means actual receipt. So here what happens is, year 1 is 10 lakhs is given, year 2 is given 30 lakhs, year 3 is given 30 lakhs. Now, you apply the formula for the first year. B is 10 lakhs, C is 0. C is 0 in all the cases because there is no allocation. D is 10 lakhs. So what is the net amount? 0. Second year, 30 lakhs is given. C is 0. What is D? Mr. Kapasi was saying that one view which the department could take was that they will proportionately take the capital account for each year. If there are 4 years involved, they will take 25% each year. So that is not provided in the Act or in the rules. So therefore, the department cannot take that kind of a. The second point he made, with which I may respectfully slightly disagree with him, is this. He said you claim it only in the first year and the subsequent years it is deemed to be 0. Where I would like to differ with him, or rather I would put a contra view, is this. Why in the subsequent years you should make it 0? Why not make it 10 lakhs in the subsequent years also? What is the definition of D in the section 45(4)? Amount standing to the credit of the balance of the specified person at the time of reconstitution. So that means just before reconstitution, what was his capital balance? Subject to the proviso adjustment. What was his capital balance? This D in the formula can never change. He can always be stated that D will always be the same amount. So in the next year also, it will be 30 minus 10, 20. The third year also, it will be 30 minus 10, 20. So the total capital gains taxable in my example, if my view is right, is 40 lakhs. As against 60 lakhs, which you would have paid if the whole amount of 70 lakhs had been paid in one year. So therefore, this is a controversial view. I'm not saying that it is so, but it is based on a literal interpretation of section 45. Now, some of you may come back and say, listen, if the literal interpretation leads to an absurd result, then that literal interpretation should be eschewed and some reasonable interpretation should be made. It's a possible view, but the counter to that is that in this, as Mr. Kapasi said in the morning, the entire section 45(4) is a fiction. And most of us would agree it is an irrational fiction. In an irrational fiction, you cannot add a further irrationalities. And therefore, the golden rule of interpretation is interpret the law as it stands, what its plain meaning stands, and there is no need for you to take an exception, to make an exception in respect of that interpretation rule, and therefore I can take the 10 lakhs every year as a deduction. Any views on this? Don't agree with me just because it is something as a C favor. Because as we are here to discuss the whole thing academically, I'm only putting forward certain propositions. So you may feel that what I'm saying is not right, or you may have a different view, and kindly express them if you have.
So going by your contra view, so that itself will be a tax plan.
Yes, no doubt about it. I have said so.
It's a planning. Whether it succeed or not, it's a planning.
It's a planning. And no, and the point is, it may not even be a planning. It may be a commercial necessity. As Mr. Kapasi was explaining in the morning, suppose let us say let's say that a chart account partner. Most of the firms don't have assets because most of the profits will be taken as the drawings or remuneration by the partners, okay, in a professional firm. So what happens? So if I have returned and ask for you a huge amount to be paid to you as a goodwill, the firm will not have enough liquid resources, and they will say, listen, we have to pay only out of our future earnings, and you agree for that. So it may be deferred over a period of time. It is not necessarily a planning, but it can be a
Real life situation.
a commercial necessity. If a commercial necessity arises like that, can you take a stand like this? Is a call you have to take. But if you take such a decision, advise the client that this may go up to Supreme Court, depending on the amount. Because if the tax amount is more than 2 crores, it won't go. Well, then only it will reach Supreme Court, assuming that decisions are in your favor, right? So this you have to keep in mind. As I said, the proposed converse is controversial. It is based on a literal reading of the definition of capital account in the formula. I have explained why it says so. And there is no provision for, this is an important point, there is no provision for adjusting amounts paid over various years, even though the tax liability is in the year of receipt. So it is important to note that the chargeability and this one has to be interpreted very strictly. You have to come within the 4 corners of chargeability and also 4 corners of the computation. In the computation, you cannot make any adjustment unless it is so permitted. You take section 45.5. I'm just giving you an example. 45.5 is with reference to the enhanced compensation received on certain compulsory acquisitions by the government. Earlier, there was a lot of issues were there because there is a time lag between the receipt of the original compensation and the enhanced compensation, because the case has to go through a series of steps of litigation before something gets finalized. So what assessees used to say is that under section 45.1, the year of taxation is a year of transfer. I have compulsory acquisition is no doubt a transfer. It has happened in the year X year, assessment year. I may receive it after 6 years, the enhanced compensation. Therefore, the enhanced compensation has to be fixed, or it has to relate back to the year of transfer. And you can tax me in the year of transfer only if there is a, either it can be done under section 147, or it can be done under section 154, or even assuming section 263 is applicable under section 263, but subject to limitation. To get over this, what the legislature parliament did was they brought in section 45(5) and said that enhanced compensation will be taxed in the year of receipt. And this is important. The cost of acquisition is nil because the entire cost of acquisition has been allowed while computing the capital gains when the original compensation was received. So legislature is aware that under certain circumstances, there is a possibility of claiming a cost of acquisition twice over, and they prevented it. Similarly, in the case of all self-generated assets, goodwill, route permits, etc., tenancy rights, they say the cost of acquisition is nil. Section 55 makes a fiction. So if you wanted that, you could have said so in 45(4). Having not said so, according to me, you can claim that 10 lakhs every year. This is something again is very relevant to the professional firms, because most of the professional firms follow cash system of accounting. So because we don't account the amount which is due, even though it is built in. So what happens in a cash system of accounting? What here the facts are like this. At the time of retirement, the outstandings, realizable outstandings are estimated by the firm. Similarly, payable liabilities which are not being brought into books are also taken into account. We will call it the net realizables, the difference between the gross amount receivable minus gross liabilities to be paid. Let us call it a net realizable. From the net realizable, for the sake of calculation, they deduct the tax which ought to have been paid on that if it had been treated as income of the firm, and then they allocate that net amount after tax to the partners in the profit sharing ratio. So let us say this 10 lakhs is the original capital on the date of retirement. Because of this particular bringing in the value of the debtors and adjusting for the liabilities, whatever the share which is credited to the net realizable to the retiring partner's account is about, let's say, 15 lakhs. There can be two methods of doing it. One is that you calculate everything outside the books and say, I will pay you 25 lakhs cash. In which case, this will fall under the example 1, as far as the firm is concerned. Now here they don't do that. What they do is, this extra amount which is payable to the partner, let's say 15 lakhs in this example, is debited to the other partners. The payment is made by the firm through check. But the entry made in the firm's book is debit the partner's account and they credit the bank account. So the question here is whether under such circumstances is there. So what are the issues there? We'll see that these are the facts on that. So again, the first two columns is similar to earlier ones. Then you have what you do is share outstanding is 10 lakhs, that comes to 20 lakhs. 5 lakhs is debited to this one, 5 lakhs is debited to other partners. So entry pass is very simple. Okay, you are debiting partners Q and R, crediting P for this 10 lakhs. Okay. Then you have the other revaluation of the assets, similar to the earlier examples, and the total amount is 1 crore 20 lakhs, and Mr. P's share is 60 lakh. So amount paid to P is rupees 80 lakhs. How that 80 lakhs comes? 60 lakhs of revaluation profit, 10 lakhs of the original capital, plus 10 lakhs, which is the net outstanding credit given to him in the example. Is that clear? Now the question is whether you are liable to pay the capital gains computation would be 60 lakh or 70 lakh. As per the proviso, any revaluation profit which is credited to the partner's capital account is to be ignored. The question here is whether this amount of 10 lakhs, which refers to the net realizables, is it a revaluation or not? As Dr. Kumar was telling us in the morning, there is a difference between revaluation and valuation. Section 45(4) says, ignore any credit due to a valuation of a self-generated asset or self-generated goodwill alone. Revaluation of profits of any asset, valuation profits of a self-generated asset, or valuation profit of a self-generated goodwill. Only these three things have to be ignored from your capital account. The question is whether the credit of this 10 lakh, extra 10 lakhs to the account of the retiring partner, is it any of these things? One view is that all these things are, first is that, as he said, it's only a valuation. It does not represent any revaluation of asset or creation of self-generated asset or goodwill. Okay. It is just a recognition of certain assets which are real assets, which are not brought into books and taken into account for the purpose of settlement of a retiring partner. Mr. Kapasi was explaining about the same problem with reference to a partnership firm in construction following the completed method of completed contract method instead of proportionate method. And he said that at the time of retirement, the whatever profits proportionate to the work done is credited into account. So here there is issue. Then when it says revaluation of any asset, we have to say that it has to, one's understanding should be that it is a revaluation of asset which is disclosed in the financial statement, that is the balance sheet. It cannot be equated with this kind of a credit is not equated with self-generated because they are not self-generated. They are all earned by exercising your profession.
Incurring expenses.
Incurring expenses, actually. Then the contra view is what? Contra view is that the revaluation will cover anything which is any asset which is not there, whether it's balance sheet or not. If you put a value to that different from what is there in the books, then that will be revaluation profit. Ask yourself a simple question. What is the book value of the assets? X rupees. What is the valuation adopted for purpose of settlement on retirement? It is Y rupees. Is there a difference? Is Y greater than X? If the answer is yes, then that any amount credited is to be deemed to be revaluation profit. This is one view. So finally, the whole thing will depend on the interpretation of the court. So this is, I just put numbers to a point expressed by Mr. Kapasi in the morning, so that you will be in a much better position to understand this and relate to this when a real life situation comes in your practice. Now, the next example is similar to case 1. But here what happens is that the sum of rupees 60 lakhs is not paid directly or paid by the firm Total amount due to the retiring partner is 70 lakhs in example 1. 10 lakhs, which is a capital account, is paid by the firm directly. The 60 lakhs is paid by the retiring partners proportionately directly to the the continuing partners to the retiring partner. So 60 lakhs is paid by the continuing partners to the retiring partner. So in this case, section 45(4) does not apply because this is a case where the payment is not made by a specified entity. Specified entity as defined in section 45(4) is a firm, a body of individuals, an association of persons. These are the three specified entities. So here, the payment is made by whom? Payment is made by a partner who is not coming within a definition of this, and therefore, this amount of extra amount which is paid to P on her retirement is not liable to be taxed in the hands of the firm under section 45(4). Now, whether the person in receipt P in the example is liable to pay capital gains on this amount under section 45(1) is an issue. Mr. Kapasi gave you a couple of decisions in the morning, starting with Kikabai Preemption 26 ITR, Mohan by Palma by 91 ITR, where the Supreme Court has held that when a partner withdraws money from this one, there is no capital gains. It is an encashment of a pre-existing right. That is not a transfer. But 45(4) does not depend on the meaning of transfer in section 2, subsection 47, because it deems it to be a transfer. Whatever happens, payment. So therefore, whether in the hands of the individual partner, 45(1) would apply or not is a controversial issue. Because the problem in saying is this. Here the money is not received directly from the firm. So the basic fact, the fundamental fact which is there in Mohan Bhai Pama and Srimod Das Ji Patel, here are these, that the money was paid by the firm. Okay. How they treat it internally is a different matter. So therefore, they say, but here, when the other partners pay, the department may argue that there is a transfer of your interest in the firm to the other partners. A partnership interest is a capital asset, there is no doubt about that. The definition of capital asset in section 214 is very wide, property of any kind. That is the opening portion of section 214. Property of any kind is a capital asset. Then there are exclusions. So therefore, the partnership interest of a person in a firm is a capital asset, and he has transferred this to the other two partners on receipt of a consideration, and therefore the 60 lakhs will get taxed in the hands of the partner under section 45. Is a possible reasonable view. But you can still go ahead and say that Mohan by Pama by principle apply because this is only an encashment of a pre-existing right. The fact that a consideration is received from a third party is immaterial. Therefore, if you look at the deed, it says that I am retiring from the firm and for consideration, in consideration of that, I am getting this. Section 45(4) does not apply at all. If section 45(4) does not apply, then all your section 48(3) clause 3 about the apportionment, etc., will not automatically apply. So you don't have any issues in the hands of the firm. All the issues are only in the hands of the partner. And if it is taxed in the hands of the partner, you have to determine whether it is a short term or a long term, depending on how long you are partner. If he is a partner for more than 36 months, then it's a long term. If less than 36 months, it will be short term. So these are the various situations under section 45(4). Now we'll come to the examples under section 9b. Just to recapitulate, kindly note that the 9b applies both to dissolution and reconstitution, and it applies only to receipt of assets, capital assets, and stock in trade. It does not apply to receipt of money. Okay, so therefore you have to be very clear. That is why there can be a possibility of double taxation. A capital asset which is taxed under 9B can also be taxed under 45(4). The capital accounts are same, the profit sharing ratios are the same. Now let us look at that. Asset 1 is a short-term capital asset. I have explained that what is A, B, C, D stands in the next slide. A is a short-term capital asset. The book value is 10 lakhs. The FMV of the asset is 25 lakhs. Profits, book profit, or sorry, no, it should not be dissolution. Let us assume that it is a retirement case. Book profits on dissolution, on retirement is 15 lakhs. Actual cost is 10 lakhs. Index cost is also 10 lakhs because it is a short-term capital asset. No indexation is permissible. You have capital gains under section 9B as 15 lakh. Then you have asset 2B, which is a long-term capital asset. That comes to 30 lakhs. Then your assets, self-generated asset, which is deemed to be a short-term capital asset only for section 45(4), not for 9B. I want to make it very clear on this. So here is 60 lakhs. Capital gains under section 9B is 60 lakhs. 4D is a stock in trade, and that amount of 10 lakhs is chargeable under section 28. Are these facts clear to you? Okay. Because any further discussion we'll go back to this facts. As I said, A is equal to short term, B is a long term capital asset, C is self-generated, D is stock in trade. These are just explained why indexation is not there, why indexation is available, etc. Now, it's very important to note that in the case of a self-generated, this one, whether it is a short term or long term will depend on when that asset was acquired by. Let us take a case. See, in the case of a goodwill, it's extremely difficult to find out when you acquired the goodwill. One simple thumb rule is the firm is in existence for more than 3 years, and therefore I am assuming that right from day one it earned a goodwill, which is not commercially correct. Or you have to start putting some arbitrary numbers to this. Oh, my goodwill started from 5th year, my goodwill started from 6th year. So there is no answer to this, because whatever decision you take will be arbitrary. Or at least in the case of a patent or any intellectual property rights, at least on the date you make the application for registration, though the registration process may take you can say that if it is subsequently registered in my name, that is the date of acquisition. In all these cases, or take a case of a route permit, is the date on which the authorities give you the route permit. The cost is nil, but it can still be a long term. As I will explain to you later, Rule 8AA covers only section 45(4). It does not cover rule section 9B. For the purpose of section 9B, whether the asset is a long term or a short term, you have to decide on the basis of the period of holding by applying the test given in section 2, subsection 42A. Am I clear on this? Okay. So therefore, applying this logic, the goodwill is a long-term asset. Since the cost of goodwill is nil, self-generated asset is nil, there is no cost of indexation, no indexation benefit. The entire fair market value will be the capital gains chargeable, either as a long term or a short term. Now, there is a circular issue, circular number 14, dated 12 June 21, where an extra statutory benefit is given while calculating the profits coming under 45. I made a mistake in earlier in saying it's a dissolution. Let's take a case of retirement. because if it's a dissolution, 45(4) will not apply at all. Only 9B will apply. So this example, from now onward, you assume there is a retirement. So what it says is, asset A short term is so much, 15 lakhs. Asset A and 2 and 3 are long term. Capital gains is 90 lakhs. Stock in trade is 10 lakh. So the short term capital gains we'll assume it taxable at 30%. So that is 4.5 lakhs. Long term capital gains is 18 lakhs. And stock in trade, that is business profit, is 30%, 30 lakhs. And therefore, under section 9B, you pay a sum of rupees 25.50 lakhs as tax. Forget the surcharge educations, because this is only for the purpose of calculation. Now, out of this 25.5, you will see that this 4.5 plus 18 relate to the capital asset. So what happens is this 22.5 lakhs is the tax relatable to the capital asset. Now, as Mr. Kapasi was telling in the morning, neither section 9B nor section 45(4) says that the profit taxed under section 9B, after tax, the net figure should be transferred to the capital account of the partners. There is nothing. This is given only by circular 14 by way of an extra statutory benefit. Since it is a benefit given to us, we will not go into the question of the virus or validity of such benefit, because we don't look at a gift horse in its mouth. But just to make it clear that understand the subject properly, we will say that there is no statutory benefit, but it has to be followed by the officers because it is issued under section 45(4), which says very clearly that is. Hence, so now how do you adjust this? What it says is, so in this example, during the year P retires. Now, earlier dissolution I talked, now I'm saying P retires and she is allotted the self-generated grant and she's also paid an amount of 15 lakhs. Total, I think this is the, okay, we will leave this here. 9B will just leave this. Case study 6 will stop here. We'll go to case study 7. This I'm not taking into 45(4), I'll take it a bit later. So next example, same PQR, same profit sharing ratio, capital balances, and P is allotted the self-generated patent and she's also paid amount of rupees 15 lakhs in cash. Total value of cash payout plus the patent is 75 lakh. The firm revalues all its assets 1, 2, 3, 4. The details of this one are this. You have the book profit on reconstitution 1 crore 30 lakhs. Out of which 1 crore 20 lakhs is relates to capital assets and 10 lakhs the asset 4 is a stock in trade. Now, important point in this example, please remember, in this example, what is given to P is only the self-generated patent plus cash. Though there is a revaluation of the other assets, there is no allotment of those assets to retiring partner. This extra revaluation is only to determine the amount payable to P. So therefore, what will happen is, out of 1 crore 30 lakhs, 50% share is of P, so 65 lakhs is given. Okay, so that how it is given, 60 lakhs by way of patent valuation and 15 lakhs by way of cash. So 75 lakhs is given. Now, you see this, I have allocated 48 lakhs to the partner's capital account. How did I arrive at this figure? Go back to the earlier slide. In this slide, you will see that under section 9B, which is the amount which is taxable. When I have revalued all assets, but I have allotted only the patent. So what becomes the subject matter of taxation under section 9B? Which one? Loud.
Only patent.
Only patent. So there is a revalue and everything else. What is taxed under 9B is only the capital gains relating to patent, which is 60 lakhs. So let us assume the capital gains tax rate is 20%, and therefore 12 lakhs is the net amount is 48 lakhs. So what circular 14 says is, because section 9B deems there is a transfer and assumes the fair market value as the amount is deemed to be earned by the partners, and it is not due to any revaluation, and therefore their circular, as per their circular, this 48 lakhs is to be allocated. One small point, though it is not there in the example, let us assume that this is a long-term capital asset like a land. I'm just giving an example. 20 lakhs is the cost. Okay. Index value is 30 lakhs. Fair market value is 40 lakhs. So the capital gains chargeable is how much? 10 lakhs. Tax on 10 lakhs is 2 lakhs. So what they say is, for the purpose of calculating the credit to the partners notionally, what is the book profit on that? The book profit on that is 30 minus 10. Example, 10 lakhs is the book value, fair market value is 30 lakhs, index value is 20 lakhs, chargeable capital gains is 10 lakhs. Tax is 2 lakhs. Now they say that, but the book profit on revaluation is 20 lakhs. 30 minus 10, 20. From 20 you deduct 2, 18, and 18 you allocate. In this case, that issue does not arise because there is no cost of acquisition and there is no indexation one as far as the self-generated patent is concerned. So hence, the 48 lakhs, which is the net amount remaining in section 9B after levying capital gains tax, is allocated to the partners as per circular 14. I'll repeat, there is nothing in section 9B, nothing in section 45(4) supporting this view. So when value of assets and cash allotted to P is 75 lakhs, capital account balance is 34 lakhs, not 10 lakhs. It is 10 lakhs plus 24 lakhs of the allocation of the net amount under section 9B, 34 lakhs and 41 lakhs. So this is how the board slightly mitigates the effect of double taxation. If this board circular had not been there, the 75 lakhs minus 10 lakhs would have come. Now, because of the board letter, that extra 60 lakhs taxation in 9B gets mitigated to the extent of 34 lakhs, 24 lakhs to a certain extent. And similarly, the other partners retires after later on time, their capital account on the date of will be accorded by taking this extra amount also. So to that is how the board mitigates the effect of the double taxation, partially. See, the next, before explaining the next slide, shall we do one thing? It's about 3:40 now. We'll break for tea now. If it's ready, we'll break, and because this is better, because this will take about 10 minutes. So do you have any doubts on any of the examples I have given so far, or any contra views? Please, can you use a mic?
Yes. So the last example, could you please rerun the last two part of calculations also?
This,
Yes. This.
see,
The 34 lakhs.
34 lakhs, how it is read, you want to know. I'll example it.
அதுக்கு முன்னாடி அதான்
See, you see the 60 lakhs here, asset 3, that is the asset which is allotted to the retiring partner. Okay. So, though it's a case of retirement, it's a 9B will apply because in a capital asset is allotted. Now, this 60 lakhs, what is the cost? 0. Being a self-generated asset. So, what is the net capital gains? 60 lakhs. What is the tax rate we are assuming? 20%. So, what is the net amount after that? 48 lakhs. This 48 lakhs of the extra amount is allocated to the partner's capital account in their profit sharing ratio. So P gets 24 lakhs, Q gets 12 lakhs, C, R gets 12 lakhs. So initial capital of 10 lakhs, which was standing to the credit of P lakhs, now because of this board circular and allocation of 24 lakhs, it becomes 34 lakhs. So that becomes D in the formula A is equal to B plus C minus D in section 45. Is that clear?
But however, I have already taxed. But however, I have already taxed that in 19. So why should I just include the same thing again? And
See, if you're not included, you're going to pay 65 lakhs. I told you explanation 2 below section 45(4) says that notwithstanding a tax is payable under section 9B, you are liable to pay tax extra under section 45(4). And this was explained by the morning speakers that there is no double taxation in law because the law permits it. The law permits economic double taxation per se. The economic double taxation is taxing the company's profits and taxing the dividends. That is economic double taxation. Whereas the legal double taxation is generally not permissible. But legal double taxation is permitted if the law says so. Here law says so very clearly. Notwithstanding you are paid on the same asset tax under section 9B, you will also liable to pay under 45(4). So to mitigate that double taxation effect, the board gives me a gratis. So that is why I'm allocating 24. If I don't allocate 24 lakhs, it will become 65 lakhs.
the additional 20 lakhs.
Yes, exactly.
we can ready sir.
Ready. So that's a good news. So let's assemble after tea.
Whoever is listening for first time, very difficult to inject that. Sir would have minimum 6 times
I'm not
read it. Minimum, sir.
I'm not understood.
Very good. It is long. Otherwise, சைக்காலஜி எப்படின்னா நீங்க மேல ஃபைல் பண்ணா 10% டிஸ்கவுண்ட், ஜூன்ல ஃபைல் பண்ணா 5% டிஸ்கவுண்ட், ஜூலை
Boarding pass, thank you. I'll take it. Now, coming to section 45(4) and rule 80AA. See, the point is, as I said, that section 45(4) does not speak even one word as to what is the capital asset, which is the subject matter of taxation, whether it is long term or short term. And section 45(4) by itself does not give any powers to the board or the rulemaking authority, central government, to frame rules on this. Okay, that's point one. The only rulemaking power is given under 48(3). 48(3) is a very simple thing which says that whatever the profits which are charged to tax under section 45(4), how they will be allocated to the remaining assets, and when those remaining assets are sold, how they will be treated. Okay, this is what section 48(3) says. For this purpose, it has given powers to the prescribed authority to frame rules. By virtue of 48(3), section rule 80AB has been made, which says how do you allocate the 45 crore to the remaining assets. But 45(4) per se, the profit, the bifurcation of profit into long term or short term, is not given in that. Now, rule 8AA 5 has been introduced by the GSR 470E dated 2721. Rule 8AA generally is about the characterization of the law asset transfer as a long-term capital asset or a short-term capital asset under certain circumstances. Okay. So in that they have introduced rule 80AA 5. It is important to note that the rule 80AA 5 starts with the amounts of profit attributable to your short-term capital asset at the time of taxation of the profits under section 45(4). So you have to apply section rule 80AA at the time of the occurrence of chargeable event under section 45(4), that is when the year of receipt. At that time, because that is the time of taxation of the profits under section 45(4). So at that time you apply the rule 80AA. What rule 80AA says is, capital asset forming part of a block of assets or a self-generated capital asset and a self-generated goodwill, and the assets which were short-term at the time of taxation are all treated as a short-term capital assets, and the balance, if any, will be treated as a long-term capital asset. This is all the rule says. Now, keep this in mind, the profit of 60 lakhs in the first example, which we have given, where the profit of 60 lakhs is taxed under section 45(4). If it consists of long-term assets and short-term assets, okay, the allocation, if it consists of the capital assets allotted to the retiring partner, consists of both long-term and short-term. Rule 80AA does not tell you how do you apportion that amount. The 60 lakhs profit which is under 45(4), Let us assume it is relates to allotment of a goodwill, which is short term, allotment of a non-depreciable asset like land, which is long term, and some other assets. Now this 60 lakhs, whatever it is, you have to bifurcate between short term and long term, because Rule 80 says that at the time of taxation, if assets are short term by their very nature, or if it is a self-generated asset, or if it is a form of block of asset, then it should be treated as a short term. Fine, I treat that amount as a short term, but how do I make the apportionment? So this is silent. So the Rule 80A is silent. There is a very serious lacuna in this. And Rule 80AB again, just to, we'll come back to it later, but we will see that Rule 80AB applies only to a 48.3 situation. It does not apply to 45.4 apportionment of capital gains. It applies only when the capital gains determined under 45.4, how it will be treated when the assets, remaining assets are subsequently sold. It has nothing to do with attribution. So now, keeping this in mind, I have given some examples. Before that, I will also say this just as a matter of information for those who are interested in pursuing this line of thought further. If you read the notification, it says by virtue of the powers given under section 48 clause 3 and section 295. 295 is the general rule-making powers granted to the authority, central government. The following rules are framed. If you look at section 48 clause 3, it has nothing to do with 45.4 profits being treated as a long-term or short-term. As I said earlier, at the cost of repetition, 48.3 only permits the 45.4 profits to be deducted from the full value of consideration when the remaining assets are sold. So 48.3 deals with the case where of a remaining assets. 45.4 deals with the case of a transferred assets to the partner that pulls apart. So reference to section 48.3 is a wrong reference, but it is also a settled law that if a source of power exists, reference to a wrong source will not make the notification invalid or the law invalid. So I'm not questioning it on 48.3 alone. Then we have to go back to section 295. Whether any such power is there under section 295. If you look at section 295, it consists of two, subsection 1 and subsection 2. Subsection 1 is a general power given to the central government to frame rules to make the provisions of the Act work. And if you look at subsection 2, it deals with individual items of rule-making powers. And you also know that the various sections in the Income Tax Act itself give the power for prescription of rules. Like 48.3 itself says that subject to the rules. If you look at the ease of taxation, section 17, it says that subject to rules. Valuation of perquisites, subject to the rules. These are all various sections themselves say the rules can be framed by the central government. 295.2 picks up certain situations and say in those situations the central government can do that. So in this context, whether the central government can take support from 295.1, which is an omnibus clause, and say that though the reference to 48.3 is wrong, reference to 295 is correct because I derive my powers from section 295.1. This is a controversial issue, but if you look at the decision of the Supreme Court in Logia Machine Tools, I don't remember the citation, which is on the validity of erstwhile Rule 19A in the concept of section 80J. The Supreme Court seems to bless that most of the rules can be covered under 295.1. So if that decision is applied, then this rule 8AA is valid. If that decision is distinguished and say, then we have a serious problem regarding the validity of rule 8AA. So this, in an appropriate case, a lawyer has to be consulted and then you have to take a decision to challenge by way of writ or not. You can't challenge the virus of a rule in an appellate proceeding under the Act. You can only file a writ petition in the High Court. So for the purpose of discussion today, we will assume that rule 8AA is valid. So you have the same profits, same partners, same revaluation profits. Now, important point notice is 60 lakhs of profits has to be bifurcated into long-term and short-term. Go back to the asset. Asset 15 lakhs is with reference to short-term capital asset by its very nature. 45 lakhs is a long-term capital asset by its very nature. 60 lakhs asset 3 is a self-generated goodwill and therefore it is short-term by rule 80AA. So out of 120 lakhs of profit on revaluation, which is there, this amount is to be, the ratio is short-term capital asset profit is 75 lakh and long-term is 45. Okay, assets. So applying rule 8AA, what we can say is amount paid to P is rupees 70 lakhs and chargeable profits under 45(4) is 60 lakh. As in all examples, the 45(4) profit is 60 lakhs. So we have to bifurcate this 60 lakhs into long-term and short-term. How do I do it? I will say long-term capital gains is equal to 60 lakhs into 45 lakh divided by 120 lakh. What is 45 lakh? The revaluation amount which is referable to a long-term asset. Profit on total profit on revaluation is 120 lakh. So I am taking 60 into 45 by 120 is 22.5 lakhs is long-term. 75 lakhs is referable to the short-term capital asset and therefore it is 75 by 120 into 60 lakhs, 37.5 lakhs. You will see here that I have apportioned it on the basis of ratio of profit on revaluation. I have not apportioned on the basis of the market value of the assets. Why I have done this? One is that I fancied it, I did it. If you want a rationalization for this view, I say, listen, if you go to rule 8AB, 8AB when it talks about allocation of 45(4) profits to various remaining assets, it says you do it on the basis of the profit on revaluation, the ratio of revaluation. So I am adopting the same this one. In your this one, you say that no, in one client's case, you say I want to allocate it on the basis of revaluation profits, which is more beneficial. In another case, the fair market value, that's more beneficial, or cost basis, you can do anything you want because the law is silent. Until Supreme Court decides that this is a method of allocation or the law is amended. So there's a serious problem on this. So it is up to you. When there is something which is silent, it is whatever allocation is to be benefit of the assets. The law is to be interpreted in that. Therefore, there can be two different interpretations possible. Accordingly, you do that. For client A, one interpretation, client B, another interpretation, client C, third interpretation. And if you are imaginative enough, any number of interpretations. Am I clear on this? Put it in a nutshell, rule 8AA per se does not talk about attribution of the 45 profits or bifurcation of 45 profits into short-term capital gains and long-term capital gains. It only deems the assets which are transferred to the partner either as a short-term or a long-term pay. Further step of bifurcating that profit into long-term and short-term is not provided in Rule 80A. Per se, Rule 80AB does not cover that. So only by process of a reasonable, any reasonable allocation method is acceptable. And the reasonable allocation method you can choose based on whichever is the most beneficial to a particular client. We'll go to the next example. The initial figures are same. Like in the previous example, she is given a general self-generated patent of about 60 lakhs market value, 15 lakhs cash. Total payment is 75 lakhs. On retirement, all assets, including stock evaluated and FME taken into account for settlement first, but no entry is passed in the books for revaluation. This is a very important. Okay. In this case, the details of the assets revalued as on the date of retirement and computation is almost similar to what we saw in the earlier example. As per Circular 14, the profits which are taxed under 9B, 60 lakhs minus 12 lakhs cap tax, 48 lakhs is allocated. Profit taxable is 41 lakhs. Whether this 41 lakh, which is now charged under section 45(4), can be allocated to, can be reduced from the full value of consideration received when the remaining assets are sold. Okay. In this case, while arriving at the profit sharing ratio, you will see one, the allocation of long-term capital gains of 41 lakhs. I have ignored the increase in stock in trade for the purpose of ratio. Because if you take the ratio, then it won't become to 100%, because the law requires that the entire profits under section 45 be apportioned in accordance with section 48(3) read with Rule 80AB. So if you take the stock in trade also, there won't be an allocation in respect of that portion to the capital assets. So there will be a shortfall. So what I have done is I have taken the interstate capital asset ratio, and then whatever is apportioned to whatever is referable to the long-term capital asset is taken there, and balance is taken as short-term. Am I clear on this? Because if you see the 41 lakh defined only the ratio of 15 is to 45 to 60. If you take stock in trade also into account, it will become 15 into 45 into 60 into is to 10. And what will get allocated will be only towards these assets will be 15 by 130, 45 by 130, 60 by 130, which will be equal to only 120 by 130. So a 10 by 30 will left out, because the 10 by 30 theoretically belongs to stock in trade. But the law does not say that you have to do this. Section 48(3) as well as Rule 80AB says that the amount of profits charged to tax under section 45(4) has to be allocated to the remaining asset in this formula. So that is why I have restricted it to 15 is to 45 to 60 and ignore the 10 on stock in trade. This case study 10, only yesterday evening, one bright junior from my office raised certain issues on the correctness of this. So I didn't have time to go through that. So for the moment, I will not discuss this 10 on the correctness of some views expressed in paragraph 6 of circular 14. Without going into the example, I will tell you what the board circular means. The board circular says that it gives an example. There's a land, there are some other assets. Okay, then it says that land is revalued, no doubt, but because the revalued FMV becomes equal to index cost, there is no tax payable under 9B. Since there is no tax payable under section 9B, 48.3 will not apply. This seems to be the reasoning of the board circular, but my junior said that this may not be a right view, sir. If you go through it, there is another view possible, and there is a possibility that the board view may be correct. So since I have not applied my mind to that second view, I will skip it for the moment. Example 10, I am not taking it now. So we'll take the next example. The assets are revalued. The profit on revaluation is 120 lakh. Then the apportionment of the profit allocated to assets 1 and 2 is given below on the basis of the ratio. Is coming to 7.5, 22.5, 30 lakh. Asset 1 is, this is the effect of section 48. Asset 1 is sold as a short term. Asset 1, 2 and 3 are remaining assets. Okay. Asset 1 is sold as a short term capital asset in future. So how will you compute the capital gains when that asset is sold in future? This is provided by section 48 read with rule 80AB. So what it says, actual sale value is 25 lakh. Then based on the earlier slide, 7.5 lakhs of the profit tax under 45(4) is attributable to this asset. So what I do is, this 7.5 lakhs I deduct from the fair market value of the full value of consideration received. When I sell the asset 1 in the future time, 25 lakhs is the actual consideration received. Because of rule 80AB, the amount of profit attributable to this asset under 45(4) is 7.5 lakhs. So therefore, the net consideration is 17.5 lakh. Cost is 10 lakh. Therefore, I am giving the short-term capital gain 7.5 lakh. If this attribution had not been there, it would have been 15 lakh. Because this extra 7.5 lakh benefit, you wouldn't have got it. If this is important, again, rule 80AA applies only at the time of taxation under section 45(4). So you look at rule 80A only for the purpose of determining the profits under 45(4) as to whether it is short term or long term or a combination of both. You don't look at a rule 80A afterwards. When the remaining assets are sold, you have to look at section 242 capital A to see whether it's a short term. If it is not a short term, it's a long term. If the remaining asset becomes, though it's a short term, let us assume a self-generated asset or any other asset, even in a block. If it was a short term or a land, let us take, on the date of retirement, the land was a short term in the hands of the partner. The land is revalued but not given to the retiring partner. Grant is continuing to be held as an asset of the firm. And after some time it is sold, let's say after 3 years or 5 years or 6 years. On the date of sale of land, by applying the general law, it is a long-term asset. The department cannot say no under rule 80AA on the date of 45(4) it was short-term and therefore it continues to be short-term even on the date of sale is not permissible because you have to apply the law with reference to the assets sold and not with reference to the profits of how for the 45(4) profits are characterized. So here if it becomes a land becomes a long-term asset. Sale value is 25 lakhs. 7.5 lakhs is the attributed amount of the 45.4 read with rule 80AB. Index cost becomes 15 lakhs, and so your net capital gain is only 2.5 lakhs. Is that clear? So here, in the case of a self-generated asset like trademark, patent, etc., the cost is nil. Since the cost is nil, there is no question of indexation, whether it's a short term or long term, is material only for the purpose of rate of tax, not for the purpose of computation of capital gains. Capital gains will be computed 75 lakhs less deduction of the 48.3 adjustment rate 30 lakhs. Balance is 45 lakhs as a long-term capital gains. You will pay the tax accordingly. The only difference, see the difference between if these amounts of 7.5 lakhs, 30 lakhs and 22.5 lakhs have been added to the cost of the asset, then you will get indexation from that year. Now you don't get indexation. So that benefit is lost. That is why the mandarins in the North Block have very cleverly said we will deduct it from the fair market value, full value of consideration received. So let us take another case of 48.3. So you have these assets. These are the profit sharing ratio. This is the capital, this one. During their period as an allotted a self-generated patent, also paid an amount of 15 lakhs. Total value of payout is about 75 lakh. All the assets, including stock in trade, are revalued at FME and taken into account for settlement purpose, but no entry is passed in the books for revaluation. The details of the assets revalued and the workings are similar to the earlier one. Though there is a revaluation of every asset, only asset which is taxed is because of the allocation of the self-generated patent of 60 lakhs that will get taxed under 9B. Okay. Now, the question is whether this amount of 48 lakh, which is the amount remaining after deducting tax under section 9B. 60 lakhs is the self-generated patent, which is the capital gains, 20% is the tax, net amount is 48 lakhs. We saw in the earlier examples, this 48 lakhs is this one. Now the question is whether this 48 lakhs can be adjusted if there is no entry passed in the books. My view is that if you don't pass an entry in the books, you may be in trouble. There could be a contra view on this, but my view is that based on Rule 80, Circular 14, you may have to revalue the assets in the books and pass the necessary journal entries crediting the partner's capital account. Please do it as a matter of abundant caution. Don't take a risk on this. The other point is, this is the same example also deals with that particular issue. So far, we are looking at section 48, clause 3, as only saying that profits under section 45(4) being dealt in a particular manner. The board's view is very categorical that it applies only to the other assets, remaining assets. It does not apply to the asset which is transferred to the partner. And by necessary extension, section 9B will not have 48(3) benefit cannot be applied to section 9B. You get the point? Board says that 48(3) will apply only to the remaining assets. subject matter of taxation of 9B is the transferred assets to the partner. Since the transferred asset is not a part of the remaining assets of the firm, the benefit of 48.3 will not be carried through section 9B. But if you look at the language used in section 48.3, it gives a possible interpretation. I'll only say a possible interpretation. I'm not making this with any sense of authority. I'm saying it gives a possible interpretation that the benefit under 48.3 can be applied to section 9B also. One serious problem that will arise is that if you look at rule 80AB, that does not say it will apply to 9B. Section 48.3 says as may be prescribed. So one question is that if it is not prescribed, can you block the application of 48.3 just because there is no prescription? Just for a moment, let us assume that 48.3 applies to 9B. Take it as a given. Okay. But because there is no prescription, can the department deny the benefit? According to me, the answer is no. The government has a duty to prescribe the rules even covering such a situation, and it cannot take advantage of its own fault and deny me the benefit. So therefore, I can take benefit on the basis of some reasonable method. This is one view possible. This is on the subject to the assumption that 48.3 applies to 9B. Now, why I say 48.3 may apply to 9B is this. Because, sorry, that particular section I am not. I don't have the act with me, otherwise I would have said. See, the later portion of section 4, those for first portion of section 48.3 refers to the computation of profits and or the profits chargeable under 45.4. The later portion of section 48.3 refers to be attributed to capital asset. It doesn't use the word remaining capital asset. And therefore, and after all, what is 48? 48 is a computation mechanism. It says that from the full value of consideration received or receivable, the following amounts can be deducted. First is the cost, which is modified index cost in the case of a long-term asset. Second is any expenditure directly incurred in connection with the transfer. Now there are three. And under section 9B, the fair market value of the asset is the full value of consideration deemed to be received. So therefore, 48.3, when it says in the later portion, does not specifically make a reference to the remaining assets. The board cannot presume it is only for the remaining assets and not for the transferred assets. If you take this view, that 9B will also apply to 48.3 or 48.3 also will apply to 9B. You cannot make the adjustment given by circular 14 of the profits of 9B being added to the capital account of the partner. Because if you do that, you will get into an iterative process. First, you will deduct the 45.4 profits from 9B, and whatever 9B taxation, again, you will bring it back to 45.4. You will readjust it, so you will go on, you will get into a loop, an iteration. So what I am assuming is that if 48.3 applies to 9B, we will not take the benefit of the circular number 14, which says that capital gains after tax under section 9B will be allocated to the partners and the partners' capital account will be accordingly increased. That portion I am ignoring it. I will not take the benefit because I can't take both. If that view is correct, again I am saying that it's a very big if. You may have to fight a very hard battle for that, and after finding that you have won the battle, there can be a retrospective amendment. Because this is a clear view of the board that 48.3 will not apply to 9B. So here what happens, based on this example, first you determine the capital gains under 45.4. That amounts to 75 lakh minus 10 lakh. 10 lakhs is the original capital. The 9B profits are not included in this 10 lakhs as per my own logic. So if it is 65 lakhs, then we come to profits under 9B. Cost of acquisition is nil because the patent this one. Now I will say allocation of profits attributable to patent under clause under 45.4. Out of this 65 lakh, based on the ratio of the various assets, 32.5 lakhs is allocated to patent. And therefore under 9B, I will determine the tax only as 27.5 lakhs. Now you have to look at the overall tax effect of 45.4 being short term, cap long term, this being long term or a short term, what is the total tax, and see whether it is beneficial to you or beneficial to follow the board circular. Yes. Second, fine.
So, but this morning session, we learned that it is the chronological order is from 9B and then 45.4 and then 48B. So in that case, initially we have to calculate 9B and that benefit has to be taken to 45.
Correct. I agree with you. See, this is Mr. Kapaz's view based on the circular. So what he said is, taking the cue from circular, the priority is section 9B is the first. Then that profit you allocate to the capital of the partners and then claim it. I said this is a board view. I'm only saying that on first principles, if you look at section 48.3 and if the courts agree with you that 48.3 does not apply only to 45.4 but is also applied to 9B. In the absence of a specific rules of such allocation to 9B profits, how will you go about it? Is what I'm trying to explain. I'm only giving an alternate view. It is not for a moment I'm ascertaining that the second view I'm expressing is right. I'm only saying it's an arguable point. Nothing more than that. It's for the courts to decide finally what is the intention of the legislature behind it and all those things. I'll give you a small aside regarding intention of legislature. So, you will see whenever a court cases come before the court, they say, what is the intention of legislature? What did the legislature mean? What did the parliament mean? What did the state legislature meant on this? So this is a meaning to be attributed. So how do you find out what the legislature is? That's what interesting. See, in US, many of the laws are almost like a private member bills. You have this famous, as far as the certification of the financial accounts. What is that? What does Saxley? What?
Sarbanes-Oxley.
Huh?
Sarbanes-Oxley.
Sarbanes-Oxley. So Sarbanes-Oxley amendment, and all the statutes in the US are called amendments. Okay, so Sarbanes-Oxley amendment. What is a Sarbanes? It's Sarbanes and Oxley are two senators who pioneered the bill, saying that the chief executive, directors, etc., should certify the accounts after the Enron scandal. Okay. So, like that, one private senator had moved a bill amendment, and then it became an act. Okay. So then, one issue out of that came before the US Supreme Court. So judges wanted to know what is the intention behind that particular one section of that particular act. They tried their best, they couldn't get anything, and they said, okay, all right, anyway, we will adjourn the case. We'll take it up on Monday. So this was on Friday. So then the judge who was on the bench, and normally US Supreme Court any case is heard by the full bench. The number of cases which go there are very less. So all the 9 judges heard the case. So one of the judges had to go to New York for the weekend. So he took the Washington, New York shuttle. So he comfortably settled himself in the aircraft. Then he turned around and much to his pleasant surprise, he found the author of that particular statute which were baffling them sitting next to him. So afterwards he said, he introduced himself. The other senator said, I know who you are, Judge, no problem. They had some pleasantries, and then the judge said, Mr. So-and-so, I have a problem. See, one case has come up before us. We are looking at this particular section, and please tell us, what is the intention behind this? What is the meaning of this? Then the senator looked back at the judge and said, Judge, it is for you to tell me what I meant. So the intention of legislature is something which what the court speaks, not what the members of the parliament say. Because as we know today, hardly any discussion takes place in the parliament before any statute. So we don't know what is so if any of you have gone through the journal last year or a couple of years back, there used to be a very excellent excerpt of the Parliament discussion on CA Act 1949. What the various members felt about various sections. There was a beautiful discussion that happened. That our journal published it. But today, if there is any amendment to CA Act, it gets done. It doesn't even get mentioned in the press. So the point is, this is what the legislative intent is also to be dug out by the court. You can't go back to the parliament and ask them, tell me, the judge cannot call the speaker and ask him to give evidence, saying what is the meaning of this. So on the same way, we can say it all depends on the intention. If the intention as stated by the board is appeals to the judge, then that will become the law. If it doesn't appeal to the judge, that will not become the law. Until they amend the act to make it clear. And when they make an amendment to the act to make it clear, it gets more complicated. Sir, it is about 4:45 now.
30
Okay. The next question is whether the attribution of the 45 profits and the 48.3 can happen to a slum sale. Let us assume that there is a reconstitution of the firm or there is the retirement of a partner, and then certain assets are allocated, 45 profits are computed, tax is paid, remaining assets are there, and the firm is carrying on its business with the remaining assets. Then after some time, the undertaking itself is sold as such, as a slum sale basis. So what happens? The profits are to be computed under section 50 capital B. You won't apply section 45(1) read with 48. Section 48 will not apply. The computation provisions under section 50B will apply. And just to remind you, the attribution of 45 profits to remaining asset happens under section 48(3), which is a part of computation under section 48. So whereas 50B is a separate computation provision. Earlier computation received for the transfer of the undertaking minus the net worth without indexation benefit. But from last year, it has been amended, section as well as the rules have been framed to say that you don't take the full value of consideration, you take the fair market value, each and every asset comprised in the this one minus the liabilities. So from the actual consideration received, it is now shifted to fair market value of the consideration. So this is a law under 50B, but the subject matter of taxation under section 50B is the transfer of undertaking on a slum sale basis. It is nothing to do with the individual assets comprised in the undertaking. They may contain long-term assets, short-term assets, depreciable assets, non-depreciable assets. anything it can be, but the final profit is always conceptually is the profit on sale of undertaking on a slum sale basis. So with this theoretical background and the fundamental point on 50B, whether 48.3 attribution can apply to 50B sale. If the undertaking is subsequently sold and profits are computed under section 50B, can you reduce the profit on revalue 45.4 profits, which is 60 lakhs in all our examples, will get reduced from the full value of consideration of the undertaking. There are two views on this. 80AB2, which is the method of allocation, and section 45, and the says that 45.4 profits have to be allocated to individual remaining assets. So therefore, an attribution, and it says in the same proportion of the valuation. So only if a cost is to be determined individually, then section 48.3 will apply. Since in the case of a slum sale, the cost is not individually determined. The cost is the net worth. Cost is the net worth, full value of consideration, the fair market value of the assets. So since the cost is net worth and not with reference to individual assets, section 48.3 will not apply if you sell the undertaking as such on slum sale basis later. This is one view. The other view is, no, look at section 63B today. It says that the fair market value of the assets have to be substituted. Therefore, there is, at least as far as the full value of consideration is concerned, there is a reference to the individual assets. Since 48.3 reduces the full value of consideration, 48.3 will apply even to 50B. This is the alternative view. My view is, I think the first view is correct. Though it is not in favor of the SSC, the first view is correct because according to me, section 48 does not apply to section 50B competition. Section 50B being a special provision will override section 48. A separate computation mechanism has been divided there, like 45.4. Just like as Mr. Kapali said in the morning that 45.4 is a separate computation section. It has nothing to do with section 48. Similarly, section 50B has nothing to do with 48, and therefore 48.3 will not apply. Rule 80AB principles cannot be there. So with this, I will stop. There have to be two more things will be there on 80AB3 and that. Anyway, I'm sure the SIRC will be sharing the PPT. So at that time, the members can go through that. So what I will do now is I will take the questions from which have come online throughout the day, and then if there are any more questions, we'll take it from the floor. You have to help me, sir. Question. I heard the speaker saying 45.4 is applicable to.
Mic.
I heard the speaker saying 45.4 is applicable to reconstitution and section 9B governs dissolution. I find in section 45 also mentioned dissolution also. This may kindly be clarified. I don't think 45.4 mentions dissolution at all. In fact, the speaker may have slightly got confused. Section 9B refers to both dissolution and reconstitution, whereas 45.4 only refers to reconstitution. It does not refer to dissolution. I think we're slightly mistaken on that. We can go through the act again and check that. When partners pay direct to retiring partner, then will not section 56.2.10 apply. 56.2.10 will not apply for the very simple reason that this is a consideration. Because when the retiring partner gets money from the partners direct and not from the firm, he is transferring his partnership interest to the existing partners, and they are paying consideration for that, acquiring that extra interest, and therefore it is not a receipt without consideration. Section 56(2)(10) will not apply. But as I was discussing in my worked out examples, 45(1) will apply in the hands of the partner is a question mark. Next. Sometimes profit sharing is based on projects or works divided between the partners. How would such cases be treated? See, the question here is that if there is a single partnership for a single project, then there is no issue. But if a same firm for different projects, the profits are being allocated on different methods, on different ratios to the partners, I have not come across so far. Have you? Suppose I'm a firm consisting of executing 5 projects. Will I say in this project A, this is the profit sharing ratio, project B, this is the profit sharing ratio, which is different? Very unlikely. So assuming that, let us assume that for the sake of this one is there, then the 45(4) has no problem at all. See, 45(4), what does it say? Take the money paid plus capital, fair market value, capital assets allotted minus capital. It has nothing to do with the profit sharing ratio. The problem will arise only in the case of allocation under 48 or apportionment under 48(3). Because only for 48(3) purposes, Rule 80AB, etc. says that you have to look into the red list circular. You say that you transfer the 9B profits in profit sharing ratio to the capital partners account. So therefore, there might be a result. Again, the law is silent on this. Possibly one view is that you take the average of all the profits as per the deed and then take it. But a serious question would remain that whether such profit sharing is permissible. Prima facie, I don't see any reason why it should not. Because Section 4 of the Partnership Act only says that it is an arrangement whereby profits are agreed to be shared, one for acting for all acting for one. Next. Any amendment, but this having different profit sharing, different projects does not affect the computation of the 45(4). It will have problem only in if Section 9B also applies, and as per Circular 14, you want to credit the 9B profits after tax to the capital accounts of the partners, then there might be an issue. Any amendment for ascertaining the cost of acquisition by recipient partner when it transfers the capital as received from the firm. This was answered by Mr. Kapase in the morning, saying that the circular gives the stepped up cost, but then the circular is silent as to whether how the period of holding will be treated in the hands of the retiring partner. When the retiring partner gets an asset from the firm, if it is a capital asset in his hands, whether he is going to, whether it will be a long term or short term is not clear. One view is that it is from the actual date of the receipt by him. The other is you also take into account the period held by the firm. So this is a controversial view, but Circular 14 allows this stepped up cost. Whatever the fair market value of the asset which is taken in the formula C will be taken as your cost in the hands of the partner. When the primary event, sir, would you like to join also?
Necessary supplementing, then I volunteer.
You can take some questions, please. No. You have to be put to the same ordeal I am put. We are equal. 50% partners. So, like in the morning, he said, I and Mr. Kapase will answer all questions. Hereafter, all questions will be answered together.
So the next question, when the primary event prompting payment to partner had preceded the insertion of 9B. As we all know, 9B is inserted from assessment year 21-22. So the primary event means the dissolution or reconstitution has preceded the insertion of 9B. Is it possible to give retroactivity to the provision for treating the receipt is taxable? So in the morning session itself, retroactivity is possible. So in 1920 financial year, a dissolution has taken place for which payment or the receipt of this 9B applicable assets are given to the retiring partner in assessment year 21-22. Is it possible? Yes. In the morning we said.
But the question is that since the one of the main taxable event is also a reconstitution or this one, which has happened prior to assessment year 21-22, just because the subsequent chargeable event is the receipt, it happens in the subsequent year is an issue.
But we are of the opinion that it is taxable.
Mr. Kapaji was of the opinion that yes.
Yes, we also agree. Thanks. That the provision is not there in statute book, is this possible? That's what he said. So the sentence you have to read together. Sentence, what is the sentence? In connection with the dissolution or reconstitution, if the partner receives either the capital asset or stock in trade. So if you read carefully the wordings, second time they repeated that during the previous year, if they are received, so the transfer first portion and then received. So 2 times they have used it. So I am of the view that the triggering point of taxation is the receipt. The condition is only the event taking place. So definitely it is on the receipt during the previous year when the law is made applicable from 21-22 assessment year. If the receipt is there, though the dissolution or say reconstitution takes place in the earlier period, definitely. Sir also has given in the examples. Second year, third year, the payment is there. 3 installments you pay. In the second year, third year, no dissolution, no reconstitution is there. Only in the very first year it is there. But even then, can we say that second year, third year, no dissolution, so it will not be applicable? Only both dissolution and the payment of money should be in reconstitution and the payment of money should be in 1 year. You cannot say.
No,
it can happen.
Not be 1 year, but at least it should be after 21-22. On or after 21-22.
Yes. So
that is the view, one of the views.
Yes. So next question, any amendment for ascertaining cost of operation by recipient part? So this is already answered, sir. Same question repeated. Yes, sir. 3 questions back. Yes, sir.
No, so
But the
those were the
primary
questions.
event
So you answer the question. Ask again.
Oh,
First question.
No, this
No,
was taken, so all the questions.
He's
Already
now
taken.
displaying, already answered
Oh,
question,
okay.
how he is displaying.
That is what, and audience, those who are online, they can unmute and actually ask the
Those who
question.
are on the online,
They can unmute.
they can unmute. Now the technical staff are permitting to unmute. Whoever wants to unmute and ask the question, they can come online and ask the question, please. There are 11. No one is there.
Hello.
80
More
plus,
participation.
no, there are 80 plus participants over there. So.
Hello.
Aruna, 80 participants are there. Yes,
Hello.
please. Now we are hearing.
Sir, my question is,
Hmm.
a new burden cannot be imposed by law when the transaction has taken place already. For example, a change in constitution has taken place in the year preceding the insertion of section 9B. Is it possible, sir?
Sir, in the Income Tax Act, retrospective amendments, number of amendments you have seen. So, these, you take it as a retroactive or say retrospective amendment itself. So, it's a retrospective amendments, a number of amendments have taken place. So,
No, it is not retrospective. Whether it is retroactive, I am asking, sir.
yes, sir will answer.
Whether it is retrospective or retroactive is only a difference between tweedledum and tweedledee. The question is that the finance bill being introduced in February 21 and the presidential assent received on 28/3/21, whether transactions which happened prior to 28/3/21 can be taxed in assessment year 21-22 under 45(4) is your question. See, in this case, as Kumar said correctly, that it is always the parliament's privilege to retrospectively or retroactively enact any provision. I will also draw your attention to the decision of the Karnataka High Court. I forgot the case inside of 40A1A. See, 40A1A, what happened was it was introduced with effect from 1/6/2005, which is not the beginning of the assessment year. The question was whether it applied to assessment year 2005-06 or only from assessment year 2006-07. Though it was introduced with 1/6/2005, the court said that it will apply from assessment year 2005-06 because the section 1 of the Finance Act said that this provision will come into effect from 1st April 2005. So therefore, there is nothing in law which prevents the government or parliament from enacting with a retrospective date or a retroactive date.
Sir, I fully agree with you. My question is, it has come into force from 2021 financial year. I agree with you, sir. A change in constitution had taken place in 1920 and the retiring partner is receiving the money or asset subsequent to insertion of the section. This is my precise question.
Sir, you are right.
To take note of Aquafarm case, Supreme Court, where it has said you cannot put a new impose a new hardship on the taxpayer subsequently, which you cannot expect, which we could not have expected.
Sir, even in the Income Tax Act, what you said is 100% right as far as the penal sections are concerned. Any penalty sections newly introduced, because the criminal law also, when the government or say parliament from particular date is prohibited means prior to that date, as if it is not permitted, but it's not indirectly punishable. So when some certain procedures are prohibited, that's a penal action means which is not permitted. Then from the day only, for earlier actions it cannot be there. Whereas this is tax levying computation, for these mechanisms it is permitted. That's what my colleague is supplementing.
Your reference to Aqua may not be right. See, in Aqua, what happened was section 43B, which was amended for removal of difficulties when they said that conversion of interest payable into your loan will not be deemed to be actual payment. While the department's view was that such a removal is an actual payment, and because of the amendment of the word for removal of difficulties, it will become applicable to earlier years also. Then the Supreme Court negated this view and said that in the context, saying that mere use of the word for removal of difficulties will not make it a retrospective amendment. If it is a retrospective amendment, the parliament must say so in clear terms. In that context, they made the observation you referred, saying that one cannot be penalized by a retrospective amendment by making some paying tax for a transaction which has already taken place. So this is the context in which Aqua Supreme Court said that. So the issue there was whether conversion of interest into your loan, in that case actually it was they introduced the debentures, whether it becomes an actual payment or not for 43B, and the explanation which was handed saying that if you convert it, it is not deemed to be actual payment. That was the issue before the court. In that context, that observation was made. So we must keep it in the proper perspective.
Thank you, sir. Thank you.
Any other question?
Thanks a lot, sir.
Hello? Any other question? Hand raise.
Hello.
Yes, please. We are listening. Please go ahead.
Is it possible to do the dissolution by the family members with the family arrangement?
This question was answered.
All the partners are family members only.
Okay. See, Narla Participant Garu,
Yes, sir.
in a partnership form, all the partners are family members.
Okay.
You are proposing that in between the family members, some settlement has taken place.
Yes, yes.
So, some and the dissolution is also taking place.
We want to do the distribution of assets to the family members for the partnership.
Yes, sir. So, just like your HU partition, case where there is no HUF, if one family members settle the assets among themselves, it is not a transfer, was the law. The decisions say, not the law, the decisions, court jurisprudence says, among the family members, if the assets inter se are transferred, it's not a transfer liable for capital gains. Now you are linking that to the partnership form. Here we are dealing with only AOP, BOI, partnership form. Even in a partnership form, if all the members are the family members, you have already recognized them in their individual status, not as a family. Firm is not equal to HUF. So the partners, because they are relatives, they dissolve the partnership and then take the assets. Your question is, can we call it a family settlement and can say that it's not a 9B or say attracted, 9B attracted? Is it your question, sir?
Yes, yes, sir. Yes, sir.
So in my view, it's a very highly risky thing. You have been all these days contending that they are individual members in their capacity as partners. Now, because the resolution, distribution of assets is taxable, no, they are all one family. Among the family members, the adjustment is made and the assets are distributed. Maybe self-contradictory. I don't think we'll sorry, you will supplement.
Just to supplement the point, I agree with his views. You may refer to, I don't remember the case law. You please go through that. There is a decision of the Karnataka High Court where by virtue of their family settlement, the companies in the group transferred assets to among themselves. The company's assets were transferred to another company. That is because of a family settlement. And the associate's company's contention was that there is no transfer because it's on account of family settlement. As explained by Dr. Kumar, the Karnataka High Court clearly held that the family settlement applies only to the members of the family per se. When a company cannot be a party to the family settlement, and therefore the question that it is not a transfer will not arise. It is actually a transfer in the hands of the company, and company will be liable to pay capital gains tax.
Any other questions, sir? Now, floor participation, sir. Any other question?
So it's a record for me that I overshot only by 7 minutes.
Sir, now the final session of vote of thanks. Dear participants, both physical and online, we are thankful to the SIRC for giving us the opportunity of presenting the subject, the most complicated subject, with the practical examples, because mere theory reproduction would not have given this much clarity. So to bring more clarity, though oral examples were given, Sri Ramasubramanian sir has explained them with the figures, so thereby much more clarity you would have got. That's why we named this as workshop. Definitely critical issues are same. The interpretational issues are many in these amendments. The nascent stage, we are, no decisions of precedents are available for us to give more clear thought. But anyhow, the opportunity given to all the three speakers, especially Pradeep Kapasi sir from Mumbai, all the way he has come, and from Bengaluru, Sri S. Ramasubramanian sir has come. I thank on my own behalf, on behalf of SIRC, the two speakers, being senior speakers, have accepted the invitation and have responded to our request positively, have come yesterday itself and have taken a lot of time, patience since morning to be with us. So I thank them profusely on behalf of the SIRC. Similarly, the physical participants, though number may be less, but I have to thank them individually because the subject with which we dealt is so serious. is more useful and having a real value addition. Similarly, from different parts, we have seen online persons and still around near 100 people are since morning they are there, and now also till evening they are actively participating. So this all goes to say that the interest among the members to learn, get updated is there, for giving us the opportunity to read once again for the speakers, as my colleagues have been saying. It's an opportunity for us also to again and again read and get say familiarity with the familiarization of the subject. So we thank all the members who have participated online also, and I thank the SIRC staff on the Saturday. They have coordinated in all respects. So I thank all the members. With this, we will conclude today.
Thank you. Thank you.
Thank you.